Thank you very much, Victor. Just a quick reminder that if you've got questions for any of the speakers, please write them down on the green question cards. I'm going to move straight away to our next speaker, who is called Christof GOVAERTS from the asset management and consulting company Econopolis. Christof, over to you. Thank you. Just show me how I think it's just a case of pressing. Yeah.
Good afternoon. I was asked to shed some light on the current state of structured finance. Where do we come from and where are we going, and have we indeed drawn the right conclusions? On the first slide, I'll give you an impression of the collateral damage. When we were asked in 2008, well, what would be the impact of the credit crisis? Well, most of us said, well, it would be something around 80 or 100 billion write-down in one quarter, and the bullish trend will resume. Well, after the facts, it turned out that it would involve 2 trillion or 2,000 billion US dollar of write-down. This, of course, had a huge impact on public finances. You remember all the bailout programs and the support programs, meaning that there was a serious hole being blown in the state of public finances worldwide. You can see that for the case of the Netherlands as well, the United States. These charts also take into account unfunded liabilities towards the future, like aging of population and pension. Here you have another. Now, what's important to remind is how will we ever get through a pre-normalization of the crisis period of 2007? What would it take? The OECD and the IMF have made some simulations, and under normal circumstances of average growth and average inflation of 2–2.5%, and taking into account the primary budget surplus of 5% of GDP, which was about what Belgium had before the crisis, it would take something like this. And this would mean that the debt situation would increase and then gradually would return to pre-normal crisis period, and that's about the year 2030. So there's still lots of things to be done, certainly in the case of public finances. Now, the most important graph, I think, for explaining what has happened is on your left-hand side, and there you see really the explosion of the credit derivative market. Now, if you take the starting point of 1998, there you have a value of almost 100 trillion. Now, in 1998, world GDP was also about the size of 100 trillion. And that has multiplied by 7. And the most interesting part is, and that's why Basel II and Basel III are so important, is it involves 80% of over-the-counter. And over-the-counter is, as we know in the past, was purely regulated, purely on price disclosure and on pricing afterwards on the secondary market. Systemic risk. Well, you see on the left-hand side the first chart, which gives you an idea of the 10 largest firms in the UK who are responsible. At 1995, they were responsible for 50% of total turnover in credit derivative markets. Now in 2010, it's almost more than 90%. So systemic risk is still very much there. So the problem of too big to fail should still be tackled. Now, modeling structured finance is a tricky business, and there are several problems which I will highlight very briefly. Number one problem was, of course, the rating agencies and the conflict of interest. If you see that rating agencies could cash very high fees for rating structured products, and at Moody's, for instance, now is for more than 50% reliant on fees coming from structured products. Problem number two I will come to in just a sec, and that's the mathematical approach, which is very, very crucial towards the future. And here we are. The bell curve is very much applicable when it comes to measuring the average height of a human being or the average age of a human being, but the bell curve distribution is totally nonsense when it comes to judging the quality of a structured product. Now, the systemic risk in 2000, for instance, was that everyone in the market used one and the same model, and all the products were conceived in one and the same way, which means that when the storm comes by, all boats will capsize in the same way. And even the guy who conceived the product, which was Mr. David Lee of JP Morgan, had to admit after the fact that the most dangerous part is when everybody is believing everything which is coming out of the model. And here you have it. This is the Gaussian distribution, which briefly means all observations, all possible scenarios are very well clustered around the mean. And the further you go in standard deviation from that mean, the probability decreases very, very fast. And that's what we call in financial markets, the tail end risk does not exist if you believe this model. Now, Benoît Mandelbrot, who died last year, was a very famous economist and mathematician, did several inquiries into the evolution of financial asset prices. And he said, well, average mean plus standard deviation, if you go take a look into the Dow Jones in between 1916 and 2003, there are a lot of events which are not supposed to happen. So extremistan, which this model does not take into account, does occur. Now we have new mathematical approaches in the insurance sector where we use extreme value theory for predicting the possible impact of natural catastrophes, etc. And we are now using these models as well, but there's still lots of work to be done. Now, the additional pitfalls of structured finance, and I think for the diamond sector, also here we touch a very important aspect. First of all, the off-balance sheet operations, that is very blatantly true. But the process of sectorization is what I call the Pilatus effect. The matter of trust has disappeared, and trust is very, very essential for doing business, I think, in the diamond sector and in all sectors where you operate. Sectorization briefly means you produce something, take it on the sheet, sectorize it, sell it into the market, and and in an anonymous investor who has got the product, well, it's not my business anymore because I've sold it and I've put it on the balance sheet. And that's what I call the Pilatus effect. So the matter of trust should come back into the financial world. Now, we've spoken a little bit also about alternative financing and commodities. Now, this is a point which the Financial Times has made on a couple of occasions clear, and which is very, very important. It's the price of copper. We've seen that a amount of copper has been held in warehouses in Shanghai, in China, along the coast, but copper is not used entirely for construction or for investment purposes. Copper is also used as collateral for financing. Why? Because a lot of companies have difficulties right now in obtaining credit from Chinese banks. Remember, the Chinese authorities have increased gradually the capital reserve requirements of banks. And a lot of financing companies which operate what I call the shadow economy are now using copper, give it as a collateral toward banks. Banks can still use it and give the money, and the money is lent. Now imagine what happens tomorrow when the price of copper declines. You have a problem in China. So this is very much an evolution we should be monitoring from close by. Leverage has been talked as well, and Basel II is trying to, and Basel III is trying to put a brake on that. Well, if you look at equity markets, I'm afraid leverage is back, and leverage is back with a vengeance. Just have a look at this graph. This graph gives you an idea of with how much money, borrowed money, one speculates on the US stock exchange market. We have a peak in 1999, then we have an acceleration in 2007, it comes down, and now you see the very, very fast acceleration as well. And this is one of the points as well why interest rates maybe should go up higher or more fast than anticipated, because this is the same old thing which happened with Greenspan and which Mr. Bernanke is now doing again. So you see that leverage is very much a problem again in these markets. To conclude, did we learn? Well, I think systemic risk is still very much there because we have less players. We also see that, for instance, in the market of primary dealers of bonds in the US, we used to have 17 players, now we have only 12 because of the bailouts and banks were disappeared. Has the problem disappeared for the public sector? No. In the private sector, for now, yes. And we're doing better and we are drawing some conclusions which are very necessary, but there's still a lot of things to be done. And as I say, Basel III has certainly some merits on banks and capital reserve requirements, but there's still a lot to be done on the case of the regulatory front. And I'd like to end up with a very nice principles taken from Nassim Taleb, who was an adept of Mandelbrot and who gave us some recommendation on why we should see to it that small is beautiful, and why we should watch out for fragility, and how can we make the system more safe in terms of robustness. So what he says is basically the same thing. What is fragile should break while it is still small. If it becomes too big, it becomes too big a problem for the world in general. People who are driving a school bus blindfold and crash should never be given a new bus. Again, the question is, the same people who maybe caused the crisis in 2007, are they still there? Are they still driving the bus? And more importantly, are they still driving the bus with the same tools and the same mathematical tools? There's something about the incentive bonus scheme, which is, I think, very clear-cut. And the problem of leverage, which I think is the most important one, which could threaten the revival or the recovery of the world economy. Solving debt with debt is not the thing we need. We need to do something more fundamental, and I'm afraid that monetary policy up until now, yes, we avoided the abyss, yes, we are back in control, or the machine is still running, but are we not running it on the same things which got us into trouble in the first place? So I think the debt problem is structural, and there still lots of things need to be done.
Thank you very much, Christof.
Thank you very much.